Welcome. I'm Nathaniel Evans. On behalf of the Utah Valley University's Plan Giving Department, we're thrilled to host this online workshop focused on transition planning for family businesses. As Utah's largest public university, Utah Valley University is committed to serving the community through accessible education and student success. We appreciate the community members and alumni who serve our students. We hope this workshop will inform and inspire you as you plan your transition strategy. This seminar is a part of a series focused on important financial topics presented by seasoned professionals in exit planning, estate planning, taxation, finance, and investment management. Many of our presenters serve on Utah Valley University's Gift Planning Advancement Board that encourages and enhances engagement and philanthropy at our university. During this webinar, your video and audio features are disabled to create a focused learning environment. At this time, I am honored to introduce our esteemed presenter, John Eunice, an expert in exit planning who will provide you with valuable insights.
Thank you, Nathaniel. Welcome, everyone. Thank you for committing your valuable time to learning more about exit planning. We're glad that you came today, and just to kick this off, I want to share with you some rather interesting statistics. The Exit Planning Institute has been conducting a longitudinal study called the State of Owner Readiness since 2012 in 12 different states. Let's begin with some of their findings to set the table for where we're headed today. Number one, on average, 80% of a business owner's wealth is tied up in the equity of the business. Number two, 63% of owners want to transition, exit, or sell within the next 10 years, 41% within the next 5. Number three, 50% of exit sales are involuntary forced exits arising from the occurrence of one or more of the 5 Ds. The 5 Ds are divorce, distress, disagreement, disability, and death. Continuing on with the survey, 95% of owners surveyed agreed with this statement that you see on the screen. Having a transition strategy is important both for my future and for the future of my business. Now, this is where I'm hoping to provide some clarity and value. My name is John Eunice. I am a founding partner of Keeler Thomas Management LLC, the Family and Enterprise Solutions Company. We have been serving families and family-owned businesses for over 43 years. Our mission is to give our families the gift of time and then guide them to attain what matters most. You may be wondering, why is a financial professional up here today talking about exit planning? Well, as I mentioned earlier, this is a foundational piece of our service offering to our clients and our community. This became a cornerstone of our advisory services because early on in our history, we saw and continue to see some difficult situations when families don't think about and proactively deal with these issues. When no exit planning is done, we see a range of unfortunate outcomes that often impact multiple generations. And finally, I'm here as one of you, a business owner. The things that I will speak on today, I've learned from personal experience. I hope I can share something that will make your pathway smoother. Today we will discuss 3 of many important pieces of exit planning. The first is owner preparedness. The second is how to think about enterprise value. And the third is the 5 steps of exit planning. So let's start with owner preparedness. The number one challenge that most owners face is that many owners are unprepared. On the left is the statement 95% of owners agreed with, and yet that very same surveyed group of owners reported the following data, which proved contrary to the statement that readiness is as actionably important to them. 58% of owners have no written transition plan. 26% have done no planning at all. 59% have no written personal plan for life after exit. And 60% do not understand what their exit options are. Sorry about that, getting a little tongue-tied. Now, what are the results of this? It's rather devastating. So if you, depending on which year you review from the study, from 2012 to the most current, only 2 or 3 of every 10 companies that went up for sale actually sold. 7 or 8 of 10 didn't. Therefore, 70% or 80% of business owners did not harvest the equity of their business. 75% of owners who sold profoundly regretted their decision 12 months after selling. And only 46.7% of owners sold at their desired price. According to the Family Firm Institute, 30% of family-owned businesses survived to the second generation, 12% survived to the third, only 3% survived to the fourth. These statistics indicate a large disconnect between what the owners said is important to them and what they're actually doing. The second challenge for business owners is that they are not focused enough on enterprise value. Owners are leaving cash on the table because they're primarily focused on generating income and not placing enough focus on building enterprise value. So what is enterprise value? Enterprise value is the sum of the tangible and intangible capital assets of your business. Let's look at each one. The tangible capital is the financial capital that you're used to kind of looking at every day. It's your cash flow, it's your profit and loss statements, which it's your balance sheet, which is a statement of assets, liabilities, and retained earnings. Very common, everyone's used to seeing that. The next, not so much. Intangible capital is made up of what we refer to as the 5 C's. Now, the 5 C's are as follows: human capital, which are the skills, talents, the ability to innovate, execute, and adapt; industry experience, tenure, and personal character of your partners and your employees. Intellectual capital is comprised of the knowledge, processes, and/or technologies that drive the unique value propositions and deliverables of your company that give it a competitive edge. Structural capital is the intellectual capital captured and maintained in written or digital form so that it is teachable and transferable. Your customer capital, customer or client capital, is the number and strength of the relationships you have with your customers and clients. And cultural capital is the set of shared attitudes, values, goals, and practices that characterize the behaviors and interactions of employees, owners, and the customers and clients. So, I want you to remember something really important. 80% of a company's value is equal to the sum of its intangible capital. Now, knowing that's the case, how should we think about value optimization? For our purposes, we want to determine the value that private capital marketplaces would pay for your business. That is the value you would receive if you sold your business to a third party in the open market. From your financial statements, they would construct your earnings before interest, taxes, depreciation, and amortization, referred to by the acronym EBITDA, EBITDA. Due to time constraints, we will stick with EBITDA, rather than deal with the sales multiples that's on the screen today. There are 2 numbers in every business: the tax number and the real number. The tax number you see regularly at the bottom of your profit and loss statement, and you're trying to keep the IRS at bay, and so you like to see those numbers as low as reasonably can be expected. However, that's not the number we use to value your business. The real number is adjusted for interest expense, taxes, depreciation, amortization, non-recurring one-time expenditures, and discretionary expenses that you may be charging the business. This is called recasted EBITDA. Most accounting systems are not built to give owners a regular feedback on their real number. The real number is typically determined in a formal valuation of your business, and yet less than 20% of business owners have had a formal valuation in the last 2 years. So once you have EBITDA, the next thing to do is to identify your multiple. As you can see from the equation, the multiple is applied to EBITDA to determine the market value of your business. The multiple is industry specific and it's determined by private capital markets, not by you. All industries have a range of multiples assigned to them by the private capital market, and those are observable. As displayed on the slide, the range of multiples in a particular industry will spread across the horizontal axis and form a bell curve. Weak, high-risk companies with low intangible capital land on the left side. They tend to be unattractive to third parties. The companies that fall on the right side of the curve are the opposite. They are strong, low-risk companies with strong intangible capital value. Most companies, however, reside somewhere in the middle. Your industry's multiple is determined by the private market in which your business exists and operates. As we said a moment ago, but bears repeating, this is beyond your control. Our goal is to help you climb to a higher multiple within the range in your industry. Optimizing your multiple will exponentially increase the value of your business and the payout you will receive from it. Consider the following scenario. Let's say your real EBITDA is $300,000 and the multiple range for your industry is from 1 to 6. A formal valuation places your multiple at 2. Your market value would then be $300,000 times the multiple of 2, equaling $600,000. If by improving your intangible capital value to an above average multiple of 4, your value becomes $1,200,000. That is assuming your EBITDA remained the same. That is an enormous increase, all brought about by optimizing your intangible capital. As you can see, focusing on and optimizing enterprise value brings enormous rewards. An additional benefit missing from the example we just discussed is that an increase in your multiple through value optimization will typically bring an increase in EBITDA as well. That grows your value even more. So here's a question, something for you to ponder today. What could identifying the value of your intangibles and your multiple make possible for you? Lastly, let's talk about the 5 steps of exit planning. One thing I would like to point out to you is that value optimization that we've been discussing really equals exit planning. And what I mean by that is that exit planning is simply good current business strategy. It occurs now, not at some later date when you want to sell. It delivers control to you, meaning you decide to keep, transition, or sell when and how you choose. And it also, in the end, increases your income and your personal wealth in an exponential level. So exit planning is a proven process, focusing on value growth and aligning business, personal, and financial goals. So here's an invitation. Take a moment today, following this workshop, to look into the future and describe in writing what your business and your personal life could be. There are 5 stages in exit planning, as we observed earlier. In order to kind of wrap your minds around what this would be like, think of a ladder. We begin at the bottom rung, and when we work our way to the top. So our first rung would be to identify the value that the private capital market would pay for your business right now. You need to identify current value, particularly the value of the intangible capital, to understand what you have today and what that potential could be. Now, part of our exit planning process is helping owners overcome certain behavioral biases. One of those biases is known as the endowment effect. And the endowment effect is an emotional bias that causes individuals to value something they own higher, often irrationally so, than its real market value. The endowment effect is often present in business owners who have dedicated their lives to the success of their companies. Now, once we've identified the value, particularly of the intangible capital, and begun the process of growing them, the next step, however, before that is to protect the value you've already built. Here's a kind of a sobering fact. There is a 50% chance that you will be hit by one of the 5 Ds. I won't discuss all of them today, but I'd like to point out a couple of ideas just to trigger some thinking for you. 50% of marriages end in divorce. Do you have a plan that allows the separation to take place fairly and in such a way as to preserve the business, which is the goose laying the golden egg for both of you? Disagreement is inevitable. I was going to say that conflict is inevitable. Do you have a prescribed process to resolve it in a way to protect the business and restore peace that everyone that works for you or works with you understands and has agreed to? Distress, there is nothing so certain as the business ups and downs that we all go through. Do you have a plan to manage through a crisis? Finally, de-risking really is mitigating personal, financial, and business risks by using partnership or buy-sell agreements or prenuptial agreements, and then going through an analysis about which risks you wish to transfer and which risks you wish to retain. You typically transfer a risk based on the damage that could be done by the occurrence that the risk insures. If that damage is significant enough to be financially catastrophic, it's a wiser decision to transfer that risk, usually through insurance, than it is to retain it. So some things that you should consider in terms of the highest probability of occurrence are health problems to be covered by health insurance. Liability issues arising from either your personal activity, your cars, or anything, or as well as product or professional liability based on what you do for a living or what products your business produces. Another thing to be thinking about is liability insurance on the properties that you own. And finally, disability. It doesn't take very long once you're disabled for you to lose something of great value. Do you have a plan in place for your business to continue in your absence, even for just a brief period of time? That's something for you to think about. Or, once again, if the occurrence of something like that is financially catastrophic, then perhaps we should be considering transferring that risk to someone who can bear it. Now, once you've de-risked and protected what you've already built, the next step is to optimize your value. I want to return to a statement that's really important. We've said it earlier, and I'm sorry for being repetitive, but 80% of the value of the business resides in the intangible, meaning non-financial capital of the business. It is critical to prioritize the strategic actions needed to increase the value of the intangible capital in the business. This is where the opportunity to significantly accelerate your business value lies. It is here that you can grow the value exponentially by increasing your multiple within your industry. Now, once you've optimized value and once you've identified your value, you have protected your value and optimized the value, then the next thing that needs to be done is to manage it. You've identified, protected, optimized your business value, are at least prepared to harvest your full value, whether or not your exit is on your terms and timeline, thinking of the 5 Ds. You emerge completely independent. Now, finally, once all that is taken care of, the final step is to actually go forward and harvest the value that you've created. You've reached the end of your value growth cycle. You're enjoying the increased personal wealth and cash flow that came from that. You are now free to consider your exit options on your terms. Keep, sell, transition, when and how you choose. Now, we've kind of covered all of the areas that we wanted to that I identified at the beginning, but there is one more thing, and here's the one more thing. We're really excited to announce the opening of the Family Enterprise Center. It is currently jointly sponsored by UVU and Keeler Thomas Management, LLC. We look forward to you, your business associates, other members of the professional and educational community joining us to build this as we go forward. Our mission is threefold. First of all, to bring together family-owned, privately held business owners into a safe environment where you can be educated, updated, and or provide support on the following areas: business value optimization, funding business growth and expansion, business transition or exit planning, economic conditions, current and their future impact, legal and income tax updates, current and future impact there, and CFO training and certification. The next thing we want to do is to provide a way for people to network, share ideas, get acquainted with other people within their industry or outside their industry who are trying to do the same thing, compare notes, and get better. And finally, we want to engage in roundtable discussions on issues that you're currently facing you as business owners. And we can actually fold those into to our gatherings as we meet and go forward. Well, we are coming to the end of our workshop today, but I'd like to suggest that you take the time to consider the following statements. Rank them as to whether or not they're important to you, and then rank them again as to whether or not you've actually achieved them. Here are some of the statements. Number 1, having a transition strategy and plan is important for my future as well as the future of my business. Number 2, I do know how much private capital markets say my business is worth. Number 3, I have an active system to measure and score the value of my intangible capital. Number 4, my business runs well without me at the helm. Number 5, the value of my financial assets outside the business can sustain our lifestyle without income from the business. Or, if we sell, there will be enough after taxes are paid to secure our lifestyle and our family's future. The next one, I have a timeline in place to transition, sell, or exit from my business. The next is, I have identified and protected the value factors I already have, meaning I've de-risked my business. Number 9, I have a written plan for my life after a transition exit or an exit that is as fulfilling or more fulfilling as my current life as a business owner. One other wonderful announcement is that on May the 21st at 8:30 a.m. at the UVU Young Living Alumni Center, we are going to be starting again the Business and Economic Forum. Now, this is sponsored by Keeler Thomas as well as Utah Valley University and a number of other sponsors. It's intended to be an educational event designed for both professionals and business owners. There will be continuing education credits for professionals. The early bird and alumni cost to register is $100, and regular registration or at the door is $125. We really hope that you'll join us there, and this is going to become, and will be for you now, a wonderful opportunity to network, learn, and have a good lunch. All right, now as we come to the end of our workshop, if you feel like you would like more help, UVU has graciously made available to you a 1-hour complimentary consultation with Keeler Thomas Management Advisors. You can indicate your interest at the conclusion of the meeting by completing the follow-up survey, or you can visit our webpage at www.keelerthomas.com and schedule a meeting at your convenience. The more prepared you come to the meeting with your information and data, the more specific answers you can get to questions regarding your unique situation. We invite you to take advantage of that and look forward to seeing you. Thank you once again for spending your time with us today. Have a great day.